All right, we'll get started. I'm Will Woodall. I'm joined by Mike Rarey as usual. Hi, Mike.
Good morning.
We're going to talk about one of our favorite topics, which is housing. There's a lot going on in the housing market. It's becoming a big sort of albatross as we sit here, as growth is slowing in the U.S. Housing is becoming a bigger and bigger issue. And we're going to also talk about the rental market, specifically what's happening in the rental market, because we've seen a lot of things happening there. So we're first going to start off with the housing market. Our prior videos had some data in them. We're going to recap a little bit of that up front, and then we'll dig into some of the newer information that we're seeing first.
Yeah, nice primer here. What's happening in the housing market and if you're looking to buy a home. So the green line is existing sales plus housing starts. Think of that as total sales activity. And then the blue line is the National Home Price Index. And what we saw is, if you go back to the 2000s, that was a full-on housing boom. Prices rising dramatically right alongside sales and starts. Mm-hmm. But the boom we've had recently that sent home prices to record highs has happened even though housing starts have lagged and existing sale activity has lagged prices as well. So right. Prices are just going up even though it's really hard to get a new home and really hard to buy a home.
Right.
Yeah.
And so the green line is essentially existing sales seems to be sort of trending downwards.
Yeah.
What's leading to that?
Yeah. So if we go through and look at some of the next few charts, we can explain that divergence. The first is buying conditions. So if you just look at consumer sentiment, this is from the University of Michigan survey. If you go out and survey consumers, is now a good time to buy homes or not? The answer is or not. It's actually the worst we've seen since the 80s. And, this survey, it doesn't matter if you're actually in the market to buy a home or not, but it shows it's a difficult time to buy a home and everybody knows it's a difficult time to buy a home, which can reduce sale activity.
Right. Yeah. It's interesting how rapidly the decline is in the number, not just the level, but the rate of change here. So let's look at a big area where we've seen a dispersion in these completions versus starts. Mm-hmm. And so maybe explain what this is and then explain how the gap is formed and how it can close.
Yeah. Obvious solution here is build more homes. There's just a shortage of supply, right? And so home builders are trying. You see the blue line, starts. They're trying to build new homes, still far lower than housing starts from the 2000s. But they're trying, and then you see completions are lagging, but they're not completing homes
right.
as efficiently as they would like. And a lot of folks have experienced that. And that's supply chain issues that we've all been dealing with, right? I mean, you technically cannot call a start a completion until it is complete, even if you're just waiting on a kitchen sink,
right?
A garage door, anything like that.
The appliances are usually the last thing to go in if you can't get them.
Yeah. So with supply chain issues, not being able to get critical parts, builders can call it a start, but not a complete.
And so what brings these two lines back together? Because they're fairly closely correlated.
Yeah. You would have to see housing starts slow down and completions ramp up. Mm-hmm. So home builders would, at this point, they are going to try to continue to increase supply of homes. If economic activity were to slow down, then they would probably reduce housing starts. So the blue line would stall out. And then if demand for new houses slows, well, then it's going to be easier to get those things you're waiting on, mm-hmm. Whether it's a garage door or whatever. So completions would catch up to starts.
Right. Yeah. Okay, so you mentioned demand. So let's talk about demand for housing because it has definitely changed or is in the process of changing for a variety of reasons. And here's the first one.
Yeah. The Fed is trying to fight inflation, right? And one of the big components of inflation is rents, and rents follow home prices. So how can the Fed possibly slow the increase in rents? Well, they have to slow the increase in home prices. And what's the primary tool they can do that? They can influence interest rates.
Right.
And so that's what we see here. The blue line is the 30-year fixed mortgage rate national average going absolutely vertical.
Parabolic. Yeah.
As the market and the banking system has started to price in a very aggressive Fed rate hike cycle.
Yeah, I don't know if we've looked back historically, but this might be the fastest increase
Yeah.
ever.
You know, mortgage rates have certainly been higher than this,
Sure.
but they've never increased this quickly in this short a period of time.
Mm-hmm.
And, you know, that may not cause home prices to go down, but it should cap them out. It makes home prices that are homes that are already becoming increasingly less affordable, even less affordable.
Right.
And so it should stall out home price appreciation in some areas.
And how does the rapid increase affect the ability for people to move or to get cash out of their house?
Yeah, if you own a home, you've seen a tremendous increase in your wealth. Home prices have gone up significantly.
Mm-hmm.
But in order to monetize that gain, well, I mean, you only have a few options. You can sell it, but if you need to get a mortgage for the next house, you're going to be paying more for the next house,
right,
or a very high price for the next house if you can get it. And if you need to finance any of that purchase, you're going to be paying a much higher interest rate. Yeah. So it should reduce selling activity,
right,
as well.
Yeah. Okay, let's move on to home buyer affordability. This is all these changes are average, but if you look regionally, there are certain areas where it's almost impossible now to afford a home, and there's areas where home affordability it hasn't increased or
Right.
it hasn't declined as much. So, take us through what we're seeing here and how it impacts the national and the regional pictures.
Yeah, recapping basically what we said in the last 4 slides, bringing it all together. Bottom line there, so that red negative 25.8% in the bottom right, that shows how less affordable homes have gotten since December 2019. So about 26% less affordable. And obviously we know incomes have been going up. That's
Mm-hmm.
great.
Mm-hmm.
That's green at the top. But home prices have gone up much faster. The median home price from $277 to $382. And that's an average nationally. So in some areas, we're talking significantly higher price increases than this. Yeah. Mortgage rates have gone up tremendously. So that means your principal and interest payment and your payment as a percentage of income have gone up 46% and 36% respectively. Very difficult, 1, to get a home, 2, to afford the home.
Right. And then you could add gas and food.
Yep. Other things you need once you're in your home.
Right.
Yeah.
Okay. So one of the, we'll talk somewhat about the regions, but one of the other big impacts is sort of this emerging new buyer in the market, which is the single family rental home REIT structures that are out there buying homes. And look at the growth of these single family rental REITs and how they're we talk about how they're impacting prices. And they are impacting prices in their regional local markets because they all seem to be consolidating in certain areas.
Yes, definitely. So listing the largest single family rental REITs by number of homes, you can see in total a little over 290,000 homes owned by these REITs, which is not a huge portion of the housing market. Right. We're going to pick on the 2 largest, Invitation Homes and American Homes for Rent, and you can see how they've been increasing the number of homes they own over time and are projected to continue to increase the number of homes they own. Mm-hmm. And the impact that this new institutional player has had on the market in some areas, you know, say, for example, Atlanta, Jacksonville, any place in Florida, Georgia, Sunbelt area, out in the West, while they may not own a huge portion of the homes in that area, they are a big portion of the sales activity that's happening in the area. Right. So they are increasingly price setters in regional markets. If you're wondering why it's so expensive in Phoenix area, well, perhaps the comp that you're going up against was one of these institutions buying and paying much more than an individual buyer might be able to, with much more attractive terms for the seller. Yeah. I mean, basically a cash offer well over asking, I'll close immediately.
Yeah, I saw a stat this morning that in some of these cities, up to 70% of the homes sold in the last 12 months were over ask. Yeah. which is crazy. And these buyers are they really don't care about price, and they're
Right.
usually all cash because
Right.
they have their financing.
Right. And business is good for them right now.
Mhm.
The dynamics of home affordability and being able to charge higher rents, which we'll show on the next few slides. I mean, it's a very attractive environment right now.
Mhm. Yeah. So let's look at affordability of buying versus renting and where that stands.
Yeah, so this is just house prices versus rents, and it's the highest basically ever seen. So if homes are too affordable for you or are not affordable, well, you basically have to rent. So that's what's happened here. Rents look the most attractive they've looked relative to buying a home
Right.
that we've ever seen.
Right.
And so more and more, those that can't buy
They
are
have
forced to rent.
Forced to rent. And ever is a long time. So this is
Right.
this is quite interesting. And we've seen the rental vacancies dramatically drop since the financial crisis.
Yeah. And so it shows that if you're a single family home renter, this means you have pricing power.
Mhm.
I mean, the lowest vacancy since the 80s. Even if you were to evict your tenant,
Yeah.
odds are somebody would be right behind them.
Right.
So you raise prices, oh, can't afford it. Well, that's too bad. There are 10 people, families behind you that will pay that rent.
Mhm.
So I'm going to evict, I'm going to raise prices. I have leverage in this market if I'm a rent setter.
And these rental REIT companies, they evict faster,
Yes.
right? So they have a different business model than
Mhm.
the mom and pop.
Exactly.
And so in terms of rental prices increasing, this is 2021, 2022 data.
Mm-hmm. Yeah.
So take us through
Yeah.
these bars.
2020 to 2021, those are the blue bars. They're kind of all over the place.
Yeah.
But then since March 2021, I mean, we've had an inflationary shock everywhere, right?
Yeah.
But on top of that, look at the rent increases. And if you focus all the way to the right, those are the ones with the highest rent increases. I mean, those are, aside from New York,
Yeah.
those are all areas that these single family REITs are targeting
Right.
as attractive areas. This is where people want to move after COVID. The weather's nice and I can work from home, and whatever the case may be. And it's really expensive to buy homes in those areas,
Right.
partially because the single
driven
family
the price
REITs are
up.
driving the
Right.
price up, but they can raise rents.
Right. So the rents, these are dramatically quick increases. So what happens when these two worlds collide, when rental prices just keep skyrocketing and home affordability just
Yeah.
still isn't there?
Yeah, there are definitely social implications here. Because if you are a rent setter, well, eventually, if you're raising rents higher than everybody else in the market, or you're a less attractive landlord,
Mhm.
word's going to get out and people aren't going to want to rent from you.
Right.
So that's a problem. Or eventually, right now consumers have savings, median incomes are up since 2019, but that can get eaten into really quickly.
Yeah.
And so you may be a rent setter on the way up. You might have to be a rent setter on the way down.
Mhm.
And mom and pop renters don't have to answer to investors.
Right.
Right? So the investors that are financing these single family REITs, if they have to reduce rents because people can't afford them, that's going to be very difficult in terms of reporting margins, earnings to shareholders and things like that. It's going to be tough.
And those companies face other pressures, right? In terms of labor to maintain their homes and financing costs. So they're getting pressure potentially from both sides.
Right. Yeah. And their cost of financing is going up as well. I mean, interest rates aren't just going up for mortgages.
Right.
They're going up everywhere.
Yeah.
Yeah.
Okay. Let's I think that this chart points to that. Maybe
Yeah.
we can just comment on how quickly these numbers have escalated.
Yeah, just looking at Invitation Homes, American Homes for Rent, how quickly they're raising rents compared to just in the CPI, if you look at rent of primary residence. I mean, it's not double, but it's close.
Mhm.
And everybody knows this now. These single family rents raise rents quicker,
Right.
they evict faster, they have more pricing power, they are rent setters. They're increasingly price setters in the housing market and rent setters in the rental market.
And so just to give you some context of what the rental market looks like, this chart sort of breaks it down by the types of rental market. So we have single family homes, buildings of 2 to 4 units, 5 or more units, mobile homes. And the single family homes is the largest portion of that market, which is an attractive business opportunity for people. And we don't see a lot of shifting in this year to year. This generally is fairly stable. Where do we see this potentially going forward from here?
Yeah, I mean, the last decade or so, 2 decades, multifamily REITs and multifamily real estate investments have been the place to be. But increasingly, now that we've had migration of people out of multifamily type housing units in more towards single family, and this has become an institutional asset class, single family REITs, would not at all be surprised if single family became a much larger share of the overall rental market.
Yeah, what's your outlook for mobile homes?
Yeah.
I've seen some really cool ones, actually.
Yeah, for sure.
Okay, let's look at the impact of all of this on economic growth and how sort of it starts to spiral if something's not done.
Yeah, near-term impacts, and then we'll talk about long-term impacts. So the near-term impact is, this is exactly what the Fed is worried about. Rent increases are stagflationary, inherently stagflationary. If you pay more for rent, none of that gets counted in real GDP. That is just inflation.
Right.
Gets counted in nominal GDP, which is grossed up for inflation. But none of it for real GDP. I am just paying more. Inflation goes up. So there's the inflationary part of stagflationary. And as I do that, I just have fewer dollars to spend on other things. So it crowds out other spending.
Right.
And that means real GDP is likely to go down. Now I can't buy as much stuff that I normally would buy. I'm going to put off other purchases. So in the near term, rent increases at this pace and magnitude are definitely contributing to an outlook of a stagflationary type economic growth environment, inflation environment, which is exactly what the Fed and investors are worried about.
And so these prices are sticky. They take a while to come back down. What is the outlook for how the Fed could help ease this pain?
Yeah. So if they can continue to raise interest rates to the point where they tighten financial conditions and reduce demand, then potentially you could see home prices come down, rents come down, less demand for high-end rents because people can't afford it. So companies like single-family REITs have to lower rents. That takes a while. Usually prices of other stuff come down quicker, and then these come down later. So if the Fed is effective at doing what they're doing, probably not going to see it in rent prices going down first. You're going to see it in prices of other stuff going down first.
Yep.
Yeah.
Okay. Let's look at real estate owned by people under 40. This is an interesting chart our research team put together.
Yeah. And so, near term, we talked about how this environment is stagflationary. Longer term, it's concerning with regards to how generations that are looking to own a single family home are going to accumulate wealth.
Right.
This has been the primary avenue for other generations to build wealth over time. And so trying to show that out in this chart, the blue line is the total value of real estate owned by people under 40. And you'll notice it goes negative. So this is net. So it basically measures the amount of equity those folks have in their home. So when you see that in the global financial crisis, housing market crash, that means in aggregate, people under 40 were underwater on their homes. They had negative equity. And you see that has recovered dramatically. So now in aggregate, they have positive value of equity in their homes. And the blue line that you're seeing though is the share of all the real estate value. And that has not recovered as quickly as the value of the real estate owned. Implying, this has been a tough go of it, tough housing market, a tough avenue to build wealth if you are under 40. Right. If you bought in 07, well, you bought it that high and then you had to ride that down, and hopefully you were able to stick with it and still build equity in your home or sell on the way up. And if you're just trying to buy a home now, well, it's going to be really hard, and you are buying high.
Yeah.
So your opportunities for equity appreciation just from, the value of your home going up from here, much harder, especially now that mortgage rates are where they're at.
Yeah. Here's a stat for you. 70% of the people looking to buy a home right now or in the next 12 months can only afford less than 50% of the homes available for sale.
Yeah. Yeah, it's tough.
Yeah. So if you're a young buyer coming into the market, you're buying at the top and you have trouble with affordability, with down payment is the number one reason, accumulating that. Number two is credit score. There's a lot of people who are trying to buy, but their credit score forces their rates even higher.
Yeah.
So until we get some relief there also, you're probably going to see these numbers continue to be high.
Yep.
All right. So in summary, how would you sort of put a bow on all this stuff?
Yeah, it's, no doubt, it's one of the most difficult times to buy a home if you're an individual. Rent looks extremely attractive compared to buying, and single family REITs or institutions are on top of that, and they're taking advantage of that. And so they are increasingly home price setters and rent setters.
Mm-hmm.
And this does not have great near-term or long-term implications. It's stagflationary. It's something the Fed's aware of, and they're trying to stop. And long-term, there are longer-term social implications here in terms of wealth building for younger generations.
Yeah. Awesome. Well, if you have any questions, you want to talk through any of this data with us or dig into any of the research on housing we have, just give us a call. We're happy to talk through it. Thanks for joining.